Money, no doubt, is critical input on the cost of production as businesses need a lot of credit facilities to survive. But in the environment where the lending rate is astronomical, many enterprises, especially small and medium scale, might find it extremely difficult to survive as their products will remain uncompetitive at the cost of production and sale prices to consumers will remain high. This development has made financial experts query the constant hike in interest rates despite the prevailing economic woes that have bedeviled the country. Recall that the Monetary Policy Committee of the Apex Bank in its recently held meeting decided to increase interest rates by 50 basis points from 17.5% to 18%. It's part of measures to tame stubborn inflation and further subsidize the fragile economy. With this latest move by the Monetary Authority, the big question on the lips of concerned Nigerians is, as the past rate hikes yielded any results, how long do we have to wait? To answer these questions and get talking very quickly, I'm being joined from our Abuja studios by the President of Capital Market Academics of Nigeria. He's a Professor of Finance and Capital Markets, Professor Uche Uwaleke. Prof, it's good to see you. It's been a while. Good afternoon.
Good afternoon, Tolu. It's indeed my pleasure.
Prof, finally we find ourselves at NPR 18%. And inflation is still above 21% side by side. What do you make of this continuous move aimed at pushing the NPR on the high side, but inflation seems not to be responding to this?
Your concerns are founded, Tolu. If you notice, since May 2022, we've had this consistent increase in the monetary policy rates, such that as we speak, I think we are talking about a hike of over 500 basis points, from 12.5 to what it is today, as 18%. And just as you also rightly observed, unfortunately, the inflation rate, which has been the target, hasn't really come down the way the central bank would have expected. Of course, the primary reason the central bank has been in pursuit of this hawkish monetary policy stance is due to the rising inflation. Central bank says it's doing that to rein in inflation, and that's why it keeps hiking rates. But I've always argued that to understand whether that is whether that will be effective has to, first of all, has to do with even the causes of the inflation, the major drivers of inflation in Nigeria. To address a problem, you need to first identify, what is driving that problem. And in our case in Nigeria, it's well known. Studies have shown that inflation rate in Nigeria is being driven more by cost-push factors, more by supply-side factors, than by monetary factors. Monetary policy essentially is what you do, economic policy that you use to, control the volume of money, the size and growth of money in an economy. And where that is not the case, if the inflation is not demand pull, if it is cost push, and you keep tightening monetary policy, you keep increasing rates in the hope that inflation will come down, of course, that may not, that objective may not be realized. So that's why I feel that the way to address inflation in the country today is to also involve the fiscal side. Let the fiscal authority address some of the major drivers of inflation, which for us, have become legacy matters, legacy issues. We're talking about the rising cost of energy, rising cost of fuel. The fuel scarcity we've witnessed the last couple of months, of course, contributed to rising inflation. Rising cost of transport. You have insecurity. You have climate change issues, flooding and all that. These are the factors that are driving inflation. If farmers are not going to farms because of insecurity, that is one major issue. And you will agree with me that the pressure is even coming more, on the food side. Food inflation today is more than 24%. In some states in the country, such as I think Kwara, is close to 30%. So if we address the issue of food output, squarely, and that's not what the central bank, is trained to do or is meant to address. It's really more from the fiscal side. I think the inflation rates, will come down. I'm not saying that, we also don't have the monetary component. Of course, that over time, over the years, we've had this increase, surge in central banks' ways and means. Central bank has been printing money, literally printing money to help finance government's, fiscal deficit. And that in itself, must have helped to also fuel inflation. So there is the monetary component, but there's also more of the supply side, component. In monetary policy framework, we talk about inflation as the target. The target of monetary policy, which is why the central bank has this long-run inflation target of between 6 and 9%. But we also have the intermediate target. Intermediate target has to do with that, that money supply. Okay. What I'm saying, my argument here is, yes, while the central bank too can continue to, implement monetary policy, control money supply, there is the overarching issue of the supply side, of the bottlenecks that we also have, which are also fueling inflation. So the approach really, for me, is not to continue to tighten interest rates, tighten monetary policy, rather hiking interest rates, because that may be counterproductive. You have said it, it goes to hurt businesses, small businesses. When access to credit becomes pretty difficult, of course, what you find is for many businesses, they can't survive. Those that depend on credit. And when businesses begin to have problems, you begin to see them folding up, begin to see them laying off staff. You also compound some of the economic problems. You have unemployment as a result of that, and so on. And these are the economy that actually needs to thrive on a low interest rate environment. When interest rates is high, very high, okay, we see the negative manifestations of that, consequence of that in the economy. In the stock market, for example, you also see that affecting the stock market. Look at what is happening recently now. Just the other day, on the 29th of March, the Nigerian Treasury bills, 364-day Treasury bill was trading at over 14.5%. As a matter of fact, 14.7%. That's pretty high. And the moment we begin to go back to that era, you remember, prior to COVID, the era in which Treasury bills begin to pay very, very high yields, what will happen? You find no real investments will happen in the economy because people will simply be going to take, take positions in Treasury bills. So that's not the kind of investments that this economy requires. Rising interest rates, as I said earlier, also impacts negatively on the stock market because, again, people begin to rebalance their portfolio in favor of fixed income, and that fixed income is the short-term fixed income, investing in Treasury bills. So for an economy like Nigeria that, is still struggling, where growth rate is still weak, the last GDP growth rate we had, 2022 GDP growth rate at 3.51%. That is still not strong enough. And for that to grow substantially, Tolu, we need to find a way to support a low interest rate environment, which is why I would advise that in the next scheduled meeting of the MPC, which is in May, the MPC should consider pausing the interest rate hike. The last one they had, they increased by 50 basis points. And to me, that's a signal to the fact that I think they're ready this time to pause. So there's need to pause the tightening that they're doing, okay, and allow even the ones they've done over time, the lag effect will still be there. Let's see how that permeates, through the economy. And let's also see working on other fronts. Let's see how that will, bring down inflation. Now, let me also
Prof, allow me to interject now, Prof. Prof, allow me to interject. Well stated and detailed analysis there to start this conversation. But I'll follow up very quickly by asking you that, as of today, bank lending rate to customers is about 29.13%. We know what this means for small businesses. So I am asking you, when the small businesses can't lend, even the big manufacturers can't lend, what happens to the economic outlook? Something seems to be wrong somewhere, and that's what we're trying to get right.
Oh yes, you find a downturn in economic activity. That's a simple way to define a recession. When you have a general downturn in economic activities, technically we say if you experience a negative growth rate in GDP for 2 consecutive quarters, you're in a recession. So we don't want to run that risk. When you raise interest rates so high that businesses can survive, particularly against the milieu, the recent milieu of cash crunch. Okay, which is also why I do not really support the idea that we can use the cash crunch aspect to cash scarcity to fight inflation, because of this idea that if there is cash scarcity, demand drops, and if demand drops, then inflation rate. For me, that creates a false sense of drop in inflation. It's not sustainable. Okay, so the rise in interest rates, as I said, that makes it difficult for businesses to obtain credit. It's not in the interest of the economy, overall interest of the economy. Look at the recent report by the Presidential Enabling Business Environment Council, the PBEC. I'm sure you saw the recent report on the ease of doing business. Okay, although that report focused on subnationals, at the level of states, but an interesting find there, has to do with the fact that Lagos State, okay, we know as the commercial capital of Nigeria, Lagos State took the 29th position. 29th position. Of course, a number of states like Gombe, Jigawa, did very well. But Lagos State too, one would expect that if you take the indicators of ease of doing business, that a state like Lagos should be doing well. Okay? And what are these indicators? Infrastructure, in particular. Okay? Whether it's electricity, whether it's motorable roads, security, and of course the issue of transparency. So Lagos State should be very high up there in terms of transparency, access to information. There's a functional website, by the Lagos State government. But what, in my view, must have dragged down Lagos State to 29th position has to do with the regulatory environment, which is also one of the key issues addressed, one of the key indicators of ease of doing business. Another regulatory environment is where you have access to credit. Okay, aside from the issue of ease of paying taxes, you have access to credit. So when people cannot access credit, in Lagos we have so many businesses, so many small businesses, and they're having difficulty accessing credit. Okay, of course you wouldn't expect the business owners there to be happy or to be satisfied with the business environment, because that study was actually a survey of the level of satisfaction of business owners. So the point I'm making is that it is not in the interest of the economy if we have this high, rate of interest, high interest environment. The argument for it, some might say, has to do with the fact that if you raise rates, for example, when inflation rate is running at 21.91% and you don't raise rates, you are widening the negative real interest rate. So you need to raise rate to close that negative, real interest rate. That's one argument. Another argument is that if rates are high, it could also attract, particularly, foreign investors, and then, kind of prevent capital outflows because your rates are high relative to other economies. But it can only happen when other factors are if you like, ceteris paribus. under the condition, for example, that you're not having, insecurity. So when you have insecurity, when you have weak infrastructure, when you have these other things, even when you raise, no matter how much you raise rates, investors are not going to come, because there are other factors to country risk assessment that they are doing, and that they are also watching. And that is why we don't take these policies as standalone. They must be part of a basket, holistic, and that's why in churning out economic policies, there is need for coordination, there is need for a handshake between the monetary, fiscal, trade, policies, so that we don't single out, each person doesn't operate in silos. We don't single out a policy and then want to implement it. There are other factors, to be considered. So for me, what is important is to ensure that going forward, the MPC recognizes the need to also support economic growth, to support small businesses, okay, and applies brake in this, monetary policy tightening. Even in the US, what is happening, we have also seen that despite the fact that inflation rate is still rising in the US, the last time I checked, over 10% in the euro area, is also rising, okay. But what has happened? The Federal Reserve, their last Federal Open Market Committee meeting, also opted to slow down the rate of tightening. I think the last one they did was just by 25 basis points. So it's important to recognize that economic growth needs to be supported, small businesses need to be supported, and to do that we can't continue to hike rates. Another aspect of the hike in rates, another implication that it has, is that it makes it even difficult for the government to borrow, particularly domestically. When you hike your rates, you increase the cost of debt service. You increase the cost of government going to borrow. I just gave you an instance of what happened recently in the case of Nigerian Treasury bills. Okay, the same thing for bonds, and even externally, you also notice that even our euro bonds, the yields are rising. So when you have all of that, the cost of debt service, becomes high. Just recently, the Debt Management Office released the debt figures for the last quarter, as at the December 2022. And what's the situation? We have also witnessed a rise in public debt stock by over 46 trillion. And if you also notice, for the external side, generally the cost of servicing, is on the rise. So all I'm saying is that we should consciously pursue low interest rate environment, and the central bank, is in a position, to do that. Why not, of course, reneging on its duty, its primary duty, which I recognize, is to maintain monetary and price stability, okay, but there is need to always create a balance. And that's why I'm happy that even during the last MPC meeting, one member out of the 12, one member actually voted to maintain a hold position, recognizing that there's need to turbocharge this economy, especially using a low interest rate environment.
IMF is worried, and our IMF is advising Nigeria now to implement fiscal policies that would help reduce poverty and prioritize better living conditions for the poor. Let's wrap up with that discussion. What do you make of this submission from IMF's chief, and how can we go about it?
Oh, okay, yes. Well, that's a welcome one coming from the IMF. But when the IMF tells you implement policies to ameliorate poverty, on the one hand, on the other hand, they're also telling you to increase. If you read the last Article 4 consultation report, the directors had with the Nigeria IMF report, it's recommending that the VAT rate should be increased. That's at 7.5% is very low. It should be increased. The Nigerian government should, consider increasing it up to 15%, or so. And they are also recommending, of course, unifying exchange rates, which I agree. And they're also recommending removal of fuel subsidy. Now, on the fuel subsidy issue, is it going to affect poverty Of course, in the immediate, if you remove fuel subsidy, transmitting through higher inflation, is possible that that will also create some poverty issues. But again, what the government can do, first let me say I'm in support of fuel subsidy removal, because it is really not in the interest of this economy, particularly in the medium to long term. But what the government can do, particularly the next administration, should begin to engage now on how to ensure that the impact of the immediate consequence of the fuel subsidy removal, will not really hurt the poor. Because we hear that if fuel subsidy goes, petrol will sell for over 450 naira per liter. Some even say 7 something per liter. So how do you ensure that the impact on the poor, is not significantly felt? It is by putting in place compensation measures, and the time to begin to do those things, is now. You don't have to wait till June, end of June or July, when you plan to remove the fuel subsidy before you begin to think about that. Okay, this is the time to engage labor. This is the time to engage all the stakeholders, to really bring out the measures to cushion the effect of fuel subsidy, as soon as the fuel subsidy is removed. So for me, I'm for fuel subsidy removal, but we should also be thinking of what to do to ensure that the impact on the poor, the impact on the masses generally, is not significantly felt on the negative side. Of course, that's what I mean.
All right, then. I must thank you so much, President of Capital Market Academics of Nigeria, Professor Uche Uwaleke. Thank you for sharing your thoughts on this very important topic of discourse this Friday. Do have a great weekend. We appreciate your contributions.
Yeah, thank you so much, Tolu.